Hey, and welcome to another edition of View from the Ranch, the May edition 2026. I'm here with my Chief Investment Officer and best amigo, Brad Tremitiere.
Hello, Greg. Happy Cinco de Mayo this month. I think we'll
Yes.
celebrate. We've got the big holiday coming up on Tuesday, so gives us time to take it easy this weekend. And
Drink a couple beers?
no, I don't. I
You
don't drink. My mom
Yeah.
does.
Your
I don't
mustache might get in the way.
drink. Well, it is kind of itchy right now, but
It's a nice like caterpillar kind of style.
yeah.
I think
Well,
the young kids are wearing like the mustaches these days. So
just wait to see what comes in June, buddy. Just wait till June. You got to keep coming back. Each month's going to get
I think our
better.
viewers can't wait to see what that is. I have no
All 12
idea.
of them. I'm sure they'll be excited.
My mom watches, so I know she's gonna dig what you're wearing. So you have a
Hello,
nice
Kathy.
sombrero. Yes, shout out to Kathy. All right, so we're in May, strong month for the month of April, which I got to give it to you. You predicted that. You were bullish. You stayed bullish when the market had a kind of a rough March. And tech had really sold off, and tech was negative for the year. Now all of a sudden, things have really changed. What? Let's review that. What gave you the confidence last month to kind of stay bullish? And
I mean, I guess as we've seen in the past, I don't know, maybe 15 years since the great financial crisis, it's like these market events come, the market excessively overreacts to it, and then things settle down. I mean, think what we had last year with the tariffs. I mean, it was like destruction for a couple of weeks, and then we flew right back up. Same thing here. Once they sniffed out that, the conflict, which still is going on, didn't seem like it was going to get worse. The market, started to resurrect itself and then accelerate moving forward. So it went further than, it's much more bullish than I thought it would be. There's other things you can look at, like commodity trading advisors that, they're getting too skewed. These big asset allocation models one way or another. Money's going to have to come back in if some of these sectors or, just looking at equity to fixed is underweight. We knew there's going to be a lot of buying by the CMTs in April. So it was a great rebound. Earnings have helped.
April was always, you had mentioned historically.
April's
strong.
Yeah, it's always been one or two. July's been better the last quarter century, and the interesting thing is some of the most recent Aprils have been rough, but historically it's been the best month. So it's good to see it get back on trend, especially back on trend versus what we saw 4 years ago in 2022. Looking at the most recent midterm year, which that April was one of the worst that we've seen in a long time. So
we had the S&P rally double digits as of right now. We're recording this on April 30th, so one final day to go, but up over 12% for the month. The Dow was up over 8, and the Nasdaq was up over 17 as we're talking right now. So
what's interesting is when you look at some of that data, like the Nasdaq, going back, as far as we can, I think it's like the 9th best month that the Nasdaq has seen since like 1973. The best month we've had since April of 2020, when we rebounded from, like we said, overreaction, and then things resurrect themselves and start to accelerate. April of 2020, after COVID, that COVID mess in March, we turned right around and just kept running. So looking at it from being one of the better months, you have to take that in context, is a lot of times the better months show up during worse periods. So a lot of the better months in the Nasdaq were around the tech bubble. So we'll have to watch this going forward. But the further you move out from these strong months, the better off the market is.
Does the speed of how quickly it rebound? I mean, because the Nasdaq was like, was losing the most year to date, and all of a sudden now it's ahead of the S&P 500 year to date on a year to date basis. So it moved pretty quickly, and what typically happens?
It's, it's as fast as it goes down is as fast as it comes up.
Yeah.
It's the same way as things, we look at some of these stocks that go flying up, and they're not going to be sustainable. They're going to come back down in similar patterns. Most of the time when we get these spike downs like we've had, sorry about my mustache, it's getting a little loose here.
Take it off.
No, let's keep the party going.
Like it? Yeah.
When things go down quickly, they usually come back quickly. We don't, the market really hasn't seen, other than 2022, a drawn out period of weakness, for a long time. Most of the weakness that we've had over the last, mustache coming off.
Oh.
The last 15 years has been, quick.
Mm-hmm.
So, knowing that we're not fighting interest rates right now, and there's some concern about oil and inflation, but not having a major overhang of interest rate, everything's probably just going to keep resurrecting itself. Doesn't mean we're not going to have volatility moving forward.
Yeah.
But
volatility is a package deal with this, all this investing, especially with tech. I mean, you just have to be prepared that we always say that it's just going to have higher volatility. You have to be able to stomach it, and you can have huge moves daily, and especially with AI trading now and just automated trading, everything moves faster and more aggressively, both up and downside. And we always say if you miss the big, if you try to time it and you get out, you miss the big up moves, you end up really underperforming. So
we've had solid data to support it too,
mm-hmm.
which is good. Most of the data we kept for the month has been, strong to very strong. We've had some weakness of the past, week and a half or so in the bond markets. But, when we look at breadth on the New York Stock Exchange, I mentioned this last month.
The spreading out of the participation, other than just the Mag 7.
When we look at, the cumulative breadth through the month of April for the NYSE, there have been 36 periods that are above average, which this year so far has been above average. And other than, in those 36 years, other than 2001 and 2002, the S&P has always finished up higher when we've been this strong. So the percentages of having a positive year are really good. Granted,
anything can happen. Yeah.
You run some planes into some buildings, all bets are off, like in 2001. But the difference between this year and those 2 years is so far this year the market's up. In both those years, the market had participation, but it was down. It was still recovering from the tech bubble hangover as well. So the participation's there. We've seen better participation in the S&P, better in the Nasdaq, and better in the Russell, which the Russell's been very strong too. So,
this is the first year I think the small caps are
mm-hmm.
outperforming large caps in a while.
And breadth did make a new high April 20th, so a week and a half ago or so.
Mm-hmm.
That was one of the reasons why we didn't think what we were going through in March would be, catastrophic. We had a new high in breadth back in February. We were able to make a new high a couple weeks ago. So that usually when you're making a new high in breadth, doesn't mean you can't have weakness, but it means it's going to be pretty well contained. You can have a 10% pullback, but it should be something that's going to be short-lived. There's no negative divergences, which is positive.
And we didn't quite get that pullback on the correction. It was, I think, 9%, so it didn't really hit the 10% target. But I mean, 10% corrections happen
mm-hmm.
once every couple years. It's a common thing, and then more significant corrections of 15 or 20% are less common. But they, we haven't had one of those in a while though too. But I think we're probably near the tail end of this expansion. I mean, it doesn't mean it's over. Like there's everything's so pricey. You hear a lot of people, a lot of research and news articles about where the S&P is at 22 times earnings, and you're starting to see some talking heads come out about future earnings saying, hey, a lot of the gains came from multiple expansion, like where PE was 15 and now it's at 22, and so you really need earnings to increase, and there's a high expectation of earnings. I think like over 20% is the expectation, and So what's your thoughts on the S&P actually realizing that with lofty expectations of good earnings? How's the earnings season?
Well, there's
on?
earnings season so far this year has been good.
Yeah.
I mean, the meeting expectations as well as raising guidance. Maybe there hasn't been as many guidance raises, but that comes with the caveat of most management teams on the conference call saying that due to higher oil prices and gas prices and the concern of inflation, we're going to maintain our guidance. Mm-hmm. So there's a chance if those pressures are removed, that earnings can again accelerate faster than what was expected. The weakness that we've seen in some areas really comes with spending. Still some of the tech names are spending an insane amount of money. They're making tons of money, but the street still doesn't like the amount of spending. The offshoot to that is that spending has to drive other companies. So instead of focusing on those companies, you look at the ancillary players that are going to benefit from all this spending. So there are certain areas that are overvalued. I mean, we always talk about how cheap NVIDIA is now relative to, Walmart and Costco. But those things aren't really going to matter until they matter. And I don't know when that is yet. And, one of the factors is there's just not as many stocks on the market as there used to be. I mean, there's less stocks, for people to chase. And the U.S. economic data has been relatively surprising to the positive side, where more of the global data has gotten weaker and will continue to get weaker the higher oil prices are, because they don't have the ability to, most countries don't have the ability to produce their own oil. So I think that works well for the U.S. It's the money machine's still going with AI spending and data center spending. So that's not going away anytime soon. That will keep driving the market. Things will get overpriced at a point, but with a Fed that's accommodative right now, or neutral,
right? They just met.
Yeah.
So it was it unanimous or?
No. It was interesting because, I think the financial media looks for things to talk about because they're running out of ideas. But they were all hot and bothered yesterday because the FOMC kept rates stable, the same rate they had before, 5 or 3.5 to 3 3/4. But there were 4 dissents. One dissent was to cut rates, but there were 3 dissents that said that, they agreed with the policy rate, but they wanted to remove some of the language into the Fed statement that talks about potential further easing, basically stating that they believe, the statement needs to change because they feel the Fed's at the place where it needs to be right now, as being neutral. They don't want to cause confusion by saying, we're expecting more rate cuts this year, or we potentially could see rate hikes this year. They believe that they're neutral, which, is where it should be. Because back in the day when the Fed talked, it wasn't, as detailed and as, overt with the data. So,
they hang on every word that
yeah.
says. If they change any one particular word,
you move a period around, they get upset. But the financial media was going crazy because there haven't been 4 dissents since 1992. And initially, I think it was viewed as a negative, but I think when rational thought came in, people realized that having a neutral stance now is probably what we need to be until we get past these issues with oil and potential inflation.
Yeah. Well, let's touch on that, because the stock market seems to be ignoring that higher oil prices, gas prices over $4 a gallon, and doesn't seem to be coming down anytime soon. We keep getting some data that the war is ending, but still nothing's really happening as far as the Hormuz and the oil shipping, and so. How much longer do you think this could go on as far as before it starts becoming an issue? Because you're starting to see a little bit elevated of inflation numbers. And so, that's certainly gonna. Unless the market can handle a little bit higher inflation, maybe it can, or maybe all these data centers, we have to get used to higher energy because of the higher demand for it with all the technology that's going on. So, it's like. it's not a problem now, like you say, until it is. It's like, when does that become a problem?
Well,
at some point.
Oil prices have remained high and the market's rocketed. The main factor, which we talked about before, is the market can handle higher interest rates. It can handle higher oil prices. It just can't handle when instruments move excessively fast, like we saw in March with, oil jumping from 65 to 105 in a couple of days. That's what damaged the market. Now we're higher now, but we've stayed in relatively narrow range the last couple of weeks, and oil futures are back into a backwardation position where the current month future is priced higher than all future contracts further out. So if I look at the May contract at like 105 for crude today at 105 a barrel, it's like 30% higher than May 2027's crude contract. It's unsustainable because, demand will be met or the supply issue will eventually be changed. Now, what's going on in the Middle East is insanely hard to figure out because I think for whatever our process over there, we've been trying to find an off-ramp now. And I think the country, the governance of Iran is so fragmented between, what's left of leadership as well as what's left of leadership inside of their army that, you really don't have any strength in leaders to be able to communicate and work through some stuff. So it's kind of drug this thing on probably longer than what we need. It's a benefit for the U.S. because if you look at tanker maps, so much has exploded in the Gulf of everything coming into, the Gulf shores to fill up, especially like over in Houston. But I don't.
The Gulf of America? Not the Gulf of Mexico.
It's the Gulf of Mexico, Gregg.
Okay.
Gulf of Mexico.
Gotcha. All right. We'll call it Gulf of Mexico.
But it affects so many of the other countries, especially like Europe. They get most of their oil from the Middle East. So it's affected them a lot worse than it's affected us.
I saw a big article of how the U.S. was shipping to Japan.
Yeah.
That was like a big headline.
Yeah.
I don't know, though. I just saw the headline of it. But, that seems like it would be a pretty good solution and benefit to us.
It can't go on forever.
Yeah.
Now, we're in a midterm year. We need an off-ramp. Because if not, then it's not going to bode well for the Republican Party come the midterms.
Mm-hmm.
So, but we need an off ramp too, just from an expense standpoint. And what have we really accomplished up there over there until we can get on the ground and see, try to get some clarity on it.
Yeah. It's not an overnight process.
No.
Sure.
It does bring up the point that you have to look at alternatives. And one of the things that's come up that's really interesting that not many people have, brought up is that, United Arab Emirates, which is the third largest producer inside of OPEC of oil, split from OPEC the other day. People have to remember that OPEC and OPEC Plus, which includes Russia, they're a cartel. They control prices. Might be somewhat of a shock at first, but if the cartel breaks up, that's going to allow oil prices to trend much more favorably to what the market is versus what the control of production is. Because if it falls apart, these countries are going to start producing like crazy because they have to generate income. And I assume that the next country, since there's been a change in leadership, I assume that Venezuela is going to drop out of OPEC, which will be another the big issue. So,
what's the repercussions of that? What's the downside of?
The downside is that there could be some additional fighting between these countries. I'm not sure we get to that point. The only downside is to energy companies, like what we saw. If we go back to like 2014, 2015, OPEC started ramping up production and slashing prices to basically try to crush the fracking business here in the U.S. And, there's a lot of companies out there that got beat up. Yeah. A lot of companies went out of business. They're very good at it. So falling oil prices really only hurts energy production. As a whole, it's great for everybody. And a great example is potash. Potash used to be controlled by a Russian cartel for decades. And when it fell apart, I think in 2011, it became excessively cheap. So if you can move something to the marketplace instead of having control through a cartel or through a government, everybody benefits. Right. So hopefully coming out of this, it's going to be something that's more beneficial for everybody. Mm-hmm. And that will, again, help overall inflation.
And the consumer, despite higher gas prices, like they're still spending. Mm-hmm. And although you see a lot of topics of how the savings rate has really gone down. And so people are concerned with that, like that people are kind of using, their last dollars to spend, but they're still spending, like they're not, in excessive debt or anything quite yet. And you have a lot of people that are dependent on, that have a lot, money in stocks. And so that's always helpful. But I did see a recent interview with like Paul Tudor where he's saying how the participation of people that have money in stocks is at like one of the highest levels ever. And so if a stock market did fall, like that could have a big domino effect. I mean, like how's your view, like the consumer holding up, the job markets? I mean, the economy grew by 2% last quarter. So, like you're saying, there really hasn't been anything that's showing a huge deterioration. It's like not too hot, not too cold.
Well, I think the GDP numbers have come in a little bit from what they were expecting, but there's still, positive numbers. Unemployment has kind of leveled out here now that we've got, that a lot of the changes to government hiring have taken place and people have been let go. And again, we're coming to the midterm, most important part of the midterm. So you're going to want these numbers to continue to look good. Mm-hmm. There can be a lot of window dressing on certain things. Consumer, I don't really understand. They continue to find a way to spend. The savings rate is still depressed from where it was pre-COVID, but spend they do. Yeah. And it's somewhat amazing, but we got to realize a lot of people are earning more now as well. So sure, if the market goes down, it will have an overall effect on spending, but we have to go back and look at basic money supply, and money supply continues to grow. So as long as money supply continues to grow, most spending concerns won't really be there.
What do you think is like the biggest risk right now to like the stock market really changing or the economy going? What are some of the things that you're paying attention to that people should maybe keep an eye out for?
I mean, everybody's going to say AI and it's going to take jobs. Well, I think we're a long way away from that.
Yeah. Right now, AI is actually the investment in it is boosting the economy.
That's one of the concerns that I would have, though, is if, Amazon had earnings, they came out and they raised Meta came out and they raised their expected earnings or expected
their outlook
spending for capital expenditures by, I think they went from expecting 115 to 135 billion up to 125 to 145. So it's like a $10 billion increase on each end.
But didn't they raise their guidance and all that though? Too?
Yeah, but all they care about spending right now because it hits their free cash flow. But that increase is much smaller than what we've seen last couple quarters. Mm-hmm. The question becomes when that spending slows across the board, how's the economy going to handle it? Because if you take data centers and AI out of the economy the last 3 years, I don't think we're nearly in the position that we are.
No,
I mean, that growth has driven everything.
Mm-hmm.
It's just important that we can now bridge the gap between, what time that has bought us to companies performing better overall that are outside the space. So, yeah, to me, the risk would just be too much exuberance. Mm-hmm. And We're not there yet, especially with the way the market's moved to new highs and have come back so quickly. We'd have to get somewhat of a a rounding, but with rounding pattern, but with a big blow off too at the same time. So
I always say markets, bull markets typically end with a sprint to the finish line, and maybe this is the start of it. We'll see. I mean, but this is where you could, if there is a sprint, this is a time where you could make a lot of money. Yeah. If that happens, we probably would be more inclined to start trimming and booking some profits. But yeah, I don't think we're quite there yet. I think there's still that blow off top, if that's going to occur. I mean, that really hasn't happened quite yet.
I'd like to see things broaden out a little bit, because this month things have come in just from a sector standpoint have come in a little bit. We need to get like consumer discretionary names moving again.
Oh, they did have a good month.
Yeah, they're still
right behind technology, consumer discretionary.
In our weekly sector work, I mean, it's not super healthy to keep having energy and utilities up near the top.
Yeah.
Utilities is a different game now because of data centers, but you want, your cyclical, discretionary, tech, industrials, financials up near the top of our rankings. And while they all have improved, we still need the other areas, the non-cyclical side, to come in a little bit more than what we'd like to see.
It seems like that would be difficult, because that's really just has to do with more of spending, and people are just holding on to their wallets a little bit more because of higher gas prices, and then that trickles down to higher, wheat prices, and go in the grocery store again. I mean, it's there's just nothing seems like it's slowing down as far as prices increasing, and so the longer this draws out, I mean, to me, that's going to be concerning. How companies are starting to adjust and raising prices, and then that we've been through this story before, and so hopefully some sort of resolution starts to becoming more apparent over in the Middle East. Well, let's talk about May. Heading into May, historically, we always hear the sell in May and go away. You're not a big believer in that.
No,
though,
it's
right?
because it should be sell in August, come back in October, but nothing rhymes with August, as we've said many times. Where we said earlier that April's been kind of the strongest month most of the time in the market. The last quarter century, it's been July. I mean, July's been a bang up of a month. So it's now become sell in August, and August and September, the 2 weak months, and maybe a little bit early into October, then things start moving higher. I mean, we've come a long way. The market obviously breaking out to new highs is great, but it needs to consolidate too as well. And May traditionally in a midterm year is not the strongest month. So we're headed into this patch, usually between May and September of midterm years, where things are just kind of blah.
Yeah, especially coming off an amazing April. So I would think it would be normal to consolidate, like you're saying.
The returns are flattish for the most part. But one thing we know is that, not to get too technical, but the midterm year has two different cycles. You have the midterm year of a first-term president and midterm year of a second-term president. So while this is Trump's first year back in office, it's really his second term. The second term midterm year usually is much stronger than what the first year term is. So that's somewhat of a positive. I like the fact that the market's been able to digest oil prices. So as long as we don't see a big acceleration there, any decline in oil prices and inflation fears will be a positive for us. And then there's one other chart pattern that I found that's just really strange. I guess we could call it the Trump technical indicator. If you, it only has 6 years, but you can overlay the market 6 year period for each of the 6 years Trump has been in office. And it's really strange because almost always there is weakness in February and March, with a relatively large market bottom in March and either late March, early April. And then for the rest of the year, the market is relatively strong, up into the right, as we like to see on the charts. So this year so far, it looks exactly the same. Is that going to hold true? I don't know. I think the more divided we come as a country politically, the more difficult, the more mudslinging will take place in going into the midterms, which could affect the market. So, and we're at new highs too, with interest rates rising at the same time. So there's a lot of things that if interest rates and oil, weaken here, it could help us go further. Yeah. But I do think that for May, we should be in a consolidation period. We're coming into the back half of earnings season. So most the big numbers are out already. We still have, for example, like NVIDIA and Broadcom will be later in May, but we don't have a massive catalyst. There's no Fed meeting in May. So, I expect something to be somewhat flattish, up or down 2%. If there's a quick resolution in the Middle East, we could go much higher. If there's a massive increase in military operations, we could see, a larger retracement of the bounce the big move that we just have had. So I just don't see, we have stopped bombing them for now, 2.5, 3 weeks. If we wanted to really finish them off like that, we could, but I think they're trying to find a more agreeable off ramp than, just decimating the country. So we can get to that point. May has a chance to be really strong. I'm trying not to have many expectations after the strong month that we've had.
Okay. Were you seeing any opportunities? I think we just made an addition in our dividend model. What was the thought process maybe?
Going along with what we've seen in oil prices, we've also seen a lot of the fertilizer and wheats, grains. And we look at those future markets, they're all priced pretty strongly right now. So there's different pockets that are going to come up. And we're still trying to find those types of names that go from, bearish to bullish type reversals that allow us to get in lower risk at a better price that, it might not be the bottom, but it's something that the patterns start to build out and the fundamentals are starting to improve. Whereas on the other side, there are still areas of the market that, probably going to start to roll over that have been leaders that, we need to be cognizant of so that if there's a problem, we get out of the way. But I think the market in general is in a good position. There's certain areas that, like the food companies, we would love to get involved with because of their yields, but I don't know how these companies are going to be in business in 5 years. Every stock goes down every single day.
Yeah. Some of the old consumer staples.
Yeah, we have to wait for an opportunity there, and it just hasn't presented itself. Yeah. So
something to keep an eye on, though, because they're much cheaper, although their earnings have been going down. But at some point, something has to give. So,
yeah. And if oil slows, if oil's come back in, basically everything outside of energy is going to be worth going after it. And financials, which really struggled in March, most of them have had incredibly strong earnings, better balance sheets, better loan portfolios, and we've really seen a lot of these names come back to life. So that's a big positive. And even when you look at some of the tech names like Amazon, Amazon looked like it was left for dead. It should have broke out and it got killed, double gap down, but it's retraced everything it's lost and made a new high.
Very quickly.
That doesn't happen to bad companies. Bad companies usually stay bad. So companies will have bad times. As long as they can resurrect themselves rather quickly, we have to expect that the trend's going to remain the same.
Okay. All right, so we're gonna stay the course and
don't drink too much on Cinco de Mayo.
Yes. Don't trade when you're drinking either. It's never a good idea. So we'll keep you posted, and if anything's changed, we'll let you know. For now, we just stay the course and continue to look for opportunities. If you need anything from us or have any questions, don't hesitate to reach out and say hola. So, all right. Well, God bless, and we'll see you next month.
Bye-bye. We're awesome. We're awesome.
That was like there's not a whole lot of substance just to talk about. You know what I mean?
Well, I mean, you don't want me to get deep. I'll get deep.